Ladies and gentlemen, good day and welcome to the Q2Fy22 earnings conference call of Bajaj Electricals, hosted by Ambit Capital. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Dhruv Jain from Ambit Capital. Thank you, and over to you, sir.
Thank you. Hello, everyone. Welcome to the 2QFY22 earnings call of Bajaj Electricals Ltd. From the management side, today we have with us Mr. Anuj Poddar, the Executive Director of the company, and Mr. E.C. Prasad, the Chief Financial Officer of the company. Thank you, and over to you, sir, for your opening remarks.
Thank you. Thank you, Dhruv. This is Anuj Poddar. Good evening, everyone, and thank you for joining us. Before I talk about our quarter performance, I'd also like to point out that we've also prepared and shared an investor presentation this quarter based on the feedback that some of you have been sharing with us. So I presume many of you already got access to that. Those who don't, please make sure you get access to that. So that shares, some insights beyond the financials, which typically many of you look for. With that, let's quickly give some opening comments on the quarter performance. As we all know, it is a very tough environment, particularly because of the cost side pressures due to commodity cost increases. In such an environment, I'm very pleased with our quarterly performance. Our consumer business has demonstrated very strong growth, I think almost industry-leading growth, and we've also kept pace on the margins. So our margins are nearly flat compared to last year. We've not dropped margins despite the pressures on commodity because we made up to many other cost initiatives. I'll be happy to talk about that later. Overall, therefore, our consumer business is up 31% on revenue and 22% on consumer EBIT. Our EPC has seen a shrinkage in total revenues, but as you know, and we've been sharing for a while, some of that is a planned reduction on a billing because we've been selective of new contracts and order book. So our revenue mix between consumer and EPC continues to be in the right direction the way we like it. I think our current quarter revenue mix is about 79 to 80% in favor of consumers. EPC continues to have a small loss, but if you continue to look at that sequentially, that loss remains contained to a small figure. In this quarter, Y-on-Y loss figure for EPC seems to show against a profit last year, but may I remind you, last year Q2 had some one-time reversals and gains in the EPC business, which is why the Y-on-Y comparison of EPC bottom line is looking slightly weak. Moving on, finance costs are coming down, PBT has improved, PAT continues to improve. Last 2 points I'll make is on the balance sheet side. As always, we've remained very focused on improving our balance sheet. Our cash from operations in this quarter has been 476 crores. Part of this has been due to vendor financing that we've introduced, about 300 crores comes from that. But over 150 to 170 crores comes from actual business operations. All of this cash almost entirely is being used to repay debt. So we've had a debt reduction of 419 crores this quarter, which has significantly brought down our debt, including debts that we had acquired from Starlight. So in all of these parameters, the underlying message that I have for you is we remain consistent on our trajectory strategically that we've been pointing out. Growth in consumer, better risk management on EPC, maintaining margins in consumer business despite all the external challenges, which means delivering better operational performance and continuing to see better and improved balance sheet every quarter. Thank you for that. With that, I'll pass it on back to the moderator for questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Renu Baid from IIFL. Please go ahead.
Yeah, hi, good evening. Congratulations for the results. I had a few questions. My first question is on the demand outlook. what would be your inputs in terms of how was the festive season offtake? And post-festive season, have we seen the broad demand momentum continuing, the strong double-digit growth that we have seen YTD in terms of performance across segments and categories, specifically appliances?
Sure. So, good evening, Renu. Thank you. As you see, in this quarter, we delivered good growth, which is obviously a function of market demand. But I would also say that the demand, having said that, is not as buoyant as it was last year post the COVID wave in terms of bounce back. By that, what I mean is that last year it was, we were struggling to service demand, and supply to demand. I think this year we're having to fight to create that demand and create that, which we managed to do. So I just think it's a little harder demand to create. That said, we are seeing growth over the previous year. Even festive, we've seen a little mix. September end, which is post Ganesh Chaturthi, etc., we saw a certain dip in demand that only started picking up towards second half of October. Part of it could be ascribed to Shraddh period, etc. But that's why I think it's a little early to see how to play out. I would want to wait till November end to see how much of that bounces back to what level. But overall, I remain optimistic. I think some of this is also reaction to inflation and price increases. But as people start to become more sanguine about that and accept that, I think we will start seeing demand come back. One last point I'll make on this. I think there's a certain level of apprehension on the third wave that may be impacting sentiment slightly. I'm nobody to say whether a third wave will happen or not medically, but I think in terms of economic disruption of any third wave will be minimal this time. I do not expect any significant disruption. As that apprehension passes away or goes away, I do believe that sentiment will continue to improve. In next 3-4 months, we should start seeing good demand trends continuing.
Right. Because my question was from the perspective that last year we had a very strong pent-up. So definitely catching up on the volumes itself will be a challenge. So even if there is this average 15% price hike that we have taken across segments and categories, so even if that delivers growth, that could be reasonably commendable. So do you at least see volumes being catch up to the previous year levels, or volume growth itself could be, or coming back to the same level of volume itself could be a challenge in the second half?
So we have to wait and see. Q3 last year was a high base for the industry, etc. But some of that high base was also tempered from stock outs, that thing. So I think somewhere there may be a compensating effect. So I do think volumes will hold out, and therefore price increase should help deliver the overall revenue growth.
Sure. Sorry, in the presentation you have highlighted that there has been market share gains witnessed across fans, appliances category. So will it be possible for you to quantify in terms of over the last 12 or 18 months, what is the quantum of market share gains that Bajaj Electricals has seen across some of the key consumer-facing segments and categories?
So, we do have certain data, but like I've shared in the past, there's 2 or 3 sets of data that tend to have a certain amount of divergence. So rather than, pay attention to the absolute numbers, you look at the trend lines in each of these 2 or 3 sources of data that we track. All of them are showing market share gains for us. But the other proxy I use, if you just look at our growth in the business in this quarter or over the last 1-2 years, as you said, that is not the pace at which industry is going. By industry, I mean the overall industry. Top 3 or 4 players are all gaining market share at the cost of overall industry. In a particular quarter, including this quarter, I think we are also at the top of almost 3 or 4 players. But I don't expect that we'll be number one amongst all the players every quarter. But I do believe all of us are gaining market share from the longer term.
Sure. And lastly, if you see the receivables movement that you have shown in the presentation, so of that almost 674 crores on the power distribution side, how would be now your exposure towards UP? And do you believe ahead of elections, one can expect the payment or release of retentions to accelerate from that particular state?
So there is, broadly from what I remember, about 400 plus out of the 670 would be UP. Both UP and non-UP are coming down. So if you look at the trajectory of total receivables, it's because both of them will continue to collect. But I would love to say, last year, and this also, if you asked me 6 months ago, I would expected 674 to be lower. Because in terms of what is due, what is the movement on ground, we expect more money to have come in sooner. But ultimately, that's the reality of, dealing on the B2G business, where there are, timeline challenges on recovering the money, but we remain confident. Every month we will recover. Even this month, which is in this quarter, Q3 also, of course, we've had more recovery. So I will share that at the end of Q3. So both are directionally moving well, and we are continuing to recover both UP and non-UP. And there's sizable visibility of that recovery continuing also. By sizable, I mean in terms of numerical value also. We have visibility of good recovery continuing.
Right. But overall, sir, appreciate the extremely informative and detailed presentation that you've put across. We hope this should be continued on a going concern basis thereafter.
Yeah, we do that every quarter. I think that feedback is taken from all of you to have a presentation, but then we wanted to also make sure we make it useful for all of you.
Thanks. I'll get back in the queue with more questions later. Thank you.
Thank you, Renu.
Thank you. A reminder to the participants, please limit your questions to 2 per participant. For any follow-up, may we request you to rejoin the queue. The next question is from the line of Nitin Gandoria from Alpha Accurate. Please go ahead.
Hello, Anuj. Congratulations for a great set of numbers. Just wanted to understand on the consumer segment margin part. So FY21, our margins were around 9.8%. And this year we saw a dip in margin led by RM. So on a going ahead basis, how do you see the consumer segment margin and our guidance of improving margin by 100 basis points every year? So can we see 11% kind of margin in FY23 and then 12% kind of in 24, something of that trajectory?
So within 2 points, according to me, our consumer margin last year Q2 was 10.7 and this year is 10. I don't know if you're seeing standalone because I have not been tracking standalone. Okay. So are we talking the same numbers?
I was saying FY21 full year standalone.
Full year basis 9.6. Yes, okay.
Yeah.
So only thing I would say is full year in a COVID year where Q1 last year was distorted, this year is distorted. I'd rather compare 3 quarters of the quarter on quarter because otherwise there's a lot of distortion coming in. That's point 1. Point 2, before I answer the full year number, this quarter also we held 10%, and that is after factoring in 7 crore additional overhead allocation. If that was not there, we would be at 10.7% in this quarter itself. Okay. Point 2 is this is after absorbing the impact of commodity costs, which have impacted gross margin, but we made up for that through other cost optimization improvements in our productivity and performance. We expect to continue to do that. Number 3, to your question, on a full year basis, we've guided 1% margin expansion every year since the last 2-3 years. But you must also appreciate that we are well ahead of the curve on that. So you'll have to give us some breathing space on what and how we manage that. As I keep saying, don't hold our success against that. We will remain true to a larger guidance and we will hope to keep delivering that. But when we are ahead of the guidance, give us some leeway to also catch up in the movement.
Okay. And lastly, Anuj, on the EPC segment, so this quarter also we have seen continued loss. And you had guided that by FY22 end will be ending with near zero kind of number. So are we on track for the EPC loss becoming zero, and how do you see this panning out?
Yes, I would yet hold to that guidance that beyond this year we should not see any losses from EPC. I would have liked to say that beyond this quarter we would not, but there has been a delay in phase 3 was mandate from the UP project, and that started, which was expected to start in Q1. By now we would have seen certain delay in margins coming on from. So we're waiting for phase 3 work to get allotted or quantified for the UP. That comes in, we have better clarity, but I would yet hold true to my guidance that beyond this year we should not have losses from EPC.
Mr. Gandoria, do you have any other questions?
Thank you.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The next question is from the line of Mukesh Badane from Kotak Securities. Please go ahead.
So I wanted to ask that in terms of the margin guidance, now since we are opening up, so apart from the cost pressure, we'll have some employee cost, as in we'll have some hiring of talent, we'll have some traveling costs, some branding cost will be there, some A&P cost will be also there, which was not done in COVID times. So what hit on the margins will this cost have? And what is the sales mix shift in terms of the actual realization of the company from last year to this year? As in, I'm trying to assess whether we are able to sell higher margin items out of our total portfolio of items or not, and any new high margin category which we are going to enter in the future or not. That's all.
So Mukesh, thank you. Firstly, on your cost question, we continue to invest in employees in terms of, for example, R&D or other specialist employee base that we are adding. We've been doing that over the last 2 years. We will continue to do that because we believe that is a payoff, so we will not shy away from that. But despite that, if you look at our trend lines on employee costs as a percent of sales or any other metric, you will see that is continuing to improve, so that shall continue to improve. Point 3, there are certain one-off costs and employee costs that continue to come. In this quarter, we've had certain exits from factory labor, etc., for which we had one-off payoffs and compensation that is also mentioned and quantified in the investor presentation. And some of those actions or activities will continue as the organization needs continue to evolve. So we will continue to do that also. Lastly, on your other cost items such as travel, etc., these have already started coming in Q2 also. They've come in Q3. They will continue. Our advertisement publicity costs have been picking up. If I talk about this quarter compared to Q2 last year, which was about 2% A&P spend, this quarter was about 2.3%. But may I also remind you that Q3 typically has a maximum ad spend because that's our big season, festive quarter, etc. So you will see a sequential rise in Q3. So these are all costs that we will not shy away. These are productive costs that actually add value to the top line and bottom line of the business. But our endeavor is to, despite these, just like we've done in Q2, etc., keep absorbing these costs and find other avenues to optimize, which is what we've been delivering. So we hope to deliver margins despite these investments in cost. One last point I would share with you in terms of employee costs. This year our increment has happened in October. So we will see impact of the employee increment from October, which is in Q3. Okay. But I think we will yet absorb that in our margins. Coming to sales mix, some of our growth that you see has happened because of sales mix improvement, both in terms of, premiumization and mix of products. If you look at mixer grinders, premiumization doesn't necessarily to us mean the same product category is getting more expensive, but also upgrading various things. The mixers, for example, we launched a 1,000-watt mixer. In fans, we are launching more products in the premium fans, which used to be completely absent in earlier. Also, to look at a Morphy Richards, portfolio that had not been growing for past few years, but this year you're seeing good growth, including this quarter, which I think is about 36% growth. So that is also delivering growth. That said, to me, premiumization strategy is not at the cost of our larger portfolio. So we are as much focusing on the overall portfolio. So we expect to drive growth across all of them. In terms of market offtake, I'm not personally seeing a greater affinity of demand on a segment versus the other, either geographically, that is urban versus rural, or premium selling more than non-premium, etc. I'm seeing that be fairly universal or democratic in terms of how the trends are across these different segments and geographies.
So what about any high margin categories are we going to enter, or in existing category only new high margin products will be launched?
So there's no new category right now that we have on the anvil to talk about.
Okay, fine. And so just one last question. In terms of the demand trend, you just touched upon the demand for premium items and demand for mass or popular category items. So are we seeing any shift in trends right now in the urban landscape?
No, at least we are not seeing that. Yes, our growth of revenue from premium is, percentage terms higher, but that's also because we launched some more products there. We had some white spaces there. So if I strip it off that, I'm not seeing a trend where one or that segment is outscoring the others.
Thank you. A reminder to the participants, please limit your questions to 2 per participant. The next question is from the line of Mayank Bhandari from Nirmal Bang. Please go ahead.
Yeah, thanks for the opportunity. Sir, my first question is regarding your working capital release. You have highlighted that 300 crore is due to the vendor financing in Q2. So, sir, I mean, how has the working capital situation changed because of this? Has the receivable positions gone down or has the creditor position has gone up? Like, I cannot see it in the balance sheet. You can help me understand that.
No, Mike, if your question is, has the receivables gone down?
Yeah, because of vendor financing, how is the receivable position changed because of vendor financing?
No, the receivable position has not changed. What has happened is we used to operate at a 30 days credit with our vendor, which we have taken that up to 120 days and helped them with the vendor finance, with understanding that the interest will be borne equally between the parties. And this is an off-balance sheet product, so it doesn't get reflected as a borrowing in our books of accounts. It's a vendor line of credit that we have created for them, and taken up the vendor credits from 30 days to 120 days.
So it does not impact the balance sheet then, you see?
So actually it frees up cash for us, right? And the cash is being used to repay debt, so brought down debt.
Okay. Fine. Sir, what is second question is...
That's in the form of cash which is on the balance sheet, right?
Okay, fine. Got it. Sir, second question is, can you give the breakdown of 603 crore of appliances in Q2 FY22? Maybe a rough estimate, which are the major appliances in that?
So we don't break that down within appliances, but of course the kitchen appliances are the dominant share in that for us. And kitchen appliances again led by mixer grinders, etc. In this in Q2, Q3 typically other domestic appliances such as water heaters, etc. start kicking in also strongly.
Okay. And sir, lastly, what would have been our market share in fans by now?
So we are a number 5 rank there. I think our rank is not changed, but overall our share is increasing.
Okay, thanks.
So if I'll put that, I think overall fans industry has grown at about 9% and we've grown at 13%. So that's the proxy for market share increase.
Thank you. The next question is from the line of Amit Mahawar from Edelweiss. Please go ahead.
Yeah, thank you. Hello, Anuj. Anuj, this is basically very impressive performance, especially on the balance sheet side, and you can see some...
Sorry to interrupt, your voice is not very clear. Can you repeat?
Just one minute. Yeah.
Am I clear now?
Much better, thank you. Amit?
So seems like we lost the connection for the current participant. A reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The next question is from the line of Yash Kotari from Citrus Advisors. Please go ahead.
Yeah, hello. Firstly, very good results. PPT was also very informative. So my first question is, any sort of demand outlook for the consumer products, as in how do you see the whole consumer electrical industry growing and the outlook for the company's consumer products division growth?
So, yes, thank you. And as I answered partly in response to Renu earlier on. I think it's been a mixed trend on demand in terms of is it a completely universal flying off the shelves demand bounce back like it was last year in Q2, Q3? No. Which means we're having to fight for the demand and create the demand and make sure we're getting the demand our way, which we've delivered in Q2. We hope to do that in Q3 also. But at the same time, I remain optimistic. I think it's partly sentiment driven. Sentiment, both a certain apprehension around third wave of COVID and a little reaction to inflation and cost increases. I think next 1 or 2 months, both of these aspects should start settling in, and therefore the sentiment should continue to improve. So if I look at it on a full year basis, I do think we will have a good demand trend ahead of us.
Okay. And any price hikes that you intend to take for any of the segments or the products?
Yes. So we've taken 3 to 4 rounds of price hike in this calendar year. We do expect to take 1 more round of price hike before the end of this calendar year. So whether in November or December, we are deciding that right now.
Okay. Thank you so much.
Thank you.
Thank you. The next question is from the line of Rakesh Roy from Insect Securities. Please go ahead.
Sir, hi, sir. So my first question regarding, sir, in Q2, sir, how is the demand scenario in rural and urban markets, sir, especially Tier 1, Tier 2 cities, sir?
So Rakesh, last year rural was outgrowing urban, was not impacted by COVID. This year we see demand in rural being almost same as urban, which means they're both going in tandem. We did see a little more, if I say, impact in rural in the initial months, but that is catching up. But it is not outgrowing urban right now.
Okay, sir. Sir, next question is, sir, any new product launch in near future, sir, or this segment, sir?
Sorry, any new product in?
Any new product launch, sir, in Q4 or Q3, sir, or next year, sir?
So if you've seen our investor presentation, we shared the recent launches. Future launches, as and when we do, we'll obviously announce that, but we don't announce that in advance. Right. But we will keep launching every quarter new products as we've been doing.
Right, sir. Okay. Thank you, sir.
Two of them, actually, I don't mind mentioning two of them because that's not covered in the deck, but we launched that in this quarter, which is on water heater. On water heaters, we're playing on safety because that's a key concern from our market insights. So we've launched two water heaters. The campaign is on air right now. One is on child safety to prevent heating, and the other is an auto shut-off to prevent energy loss and overheating of the water heater. So it's already launched, but we continue to have more new launches.
Yes, sir. Or any, sir, just any plan to launch new premium fan in Q4 or from Q1 new season starts, sir?
Yeah. So we will be doing that in due course in the coming couple of years.
Right, sir. Okay, sir. Thank you, sir. Thank you for my side.
Thank you, Rakesh.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The next question is from the line of Bhargav Buddhadev from Kotak Mutual Fund. Please go ahead.
Yeah, congratulations for a very good set of performance and a very detailed presentation. Sir, my first question is that in your receivables table, I see about 674 crores from power distribution. So assuming this entire amount gets cashed in, will there be a provision right back as well because you will have provided on this amount as well?
You can answer, but as far as I understand, this is net of all provisions.
Yes. So this is net of the provisions. Our provision for bad and doubtful debt stands at 147 crores. But this 674 crores that you're referring to for PD is the net of all the provisions that we have made.
Okay, understood. And my second question is in extension of Mayank's question. So when I look at your cash flow statement, there is a mention of 300 crores vendor financing. So the acceptances shouldn't have gone up by 300 crores ideally?
It's a part of the other financial liabilities.
So in the cash flow statement, we can see that, is it?
Not in the cash flow statement.
So ideally, if you are mentioning a release of 300 odd crores in your working capital, it is a funded release, right? It's a release from your operation. You borrowed money to pay your creditors. So ideally, it should get reflected in your cash flow statement.
Okay, give us a minute. They're just pulling out the numbers. If you have another question, we'll come back to this one.
No problem. I'm done from my side. Thank you very much.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time.
One thing, we can go back and answer the last question, Bhagav's question. Yeah, if you can pull out the cash flow statement.
So if you can pull up the cash flow, it's a part of that increase in trade payables, provision, employee benefit, other financial liabilities. It's a part of that. 246.17 CR.
Thank you. The next question is from the line of Kaundinya Nimagada from JM Financial. Please go ahead.
Yeah, hi sir. Thanks for the opportunity, sir. Can you quantify the extent of price hikes that you took in the calendar? You said that you took 3 or 4 price hikes. Can you quantify them and also in both of categories is significant?
So it's been across categories. To just generalize, to give you a range, it's been between 12 to 15% across the categories in about 3 to 4 rounds.
Understood. And you did allude to the fact that you're planning more price hikes in November and December, and at the same time you also confirmed that, or at least you made a comment that, price hikes may have an impact on demand. So how do you try to streamline between these two, balance between these two? And what's your outlook on that?
Yeah, so of course that's what we have to always keep trying to, have a good judgment on demand elasticity, margins versus total trade-off and operating leverage on that. We do think we need to take one more price hike, most likely within this quarter. That will not be across all categories, but will definitely be across about 70 to 80% of our product portfolio. Timing of that, the exact quantum of that, we will, decide closer to the timing of taking the hike.
Sure. Sir, can you comment a little bit about, how the water heaters industry, market is faring now in the current season, and what is the competitive intensity like?
So on competitive intensity, I will tell you there's never an easy day. All across all our product categories in the FMEG in the last 6-8 quarters that I've been seeing it, competitive intensity has only been increasing. So that remains. So, that is not something we are scared of. We continue to deal with that on an ongoing basis. Water heaters is no exception, but we've been leaders. Last year also was very competitive, but we did very well in water heaters. And I believe that should continue this year also. We are just at the start of the water heater season right now. And winter is just starting to kick in, so we're just starting to see the initial trends of demand on water heaters and room heaters. And we have also...
the reason I'm asking the question, so the reason I'm specifically asking about water heaters is because one of your competitors has mentioned that, because most players that have air coolers also have water heaters as an alternate category. And with 2 consequent years of lockdowns in the summer season, the competitive intensity has gone up in water heaters, thereby restricting players to take price hikes. So I was trying to understand from that perspective, if there has heightened it further.
But actually, if you see, the leading players in air coolers are not necessarily the leaders in water heaters. So they are not, while it's seen as an alternative thing, I think they're 2 separate set of, leadership or market shares of pecking order in both of these industries. And I don't think there's a direct correlation between air cooler and water heater performance. Having said that, yes, to your point, water heater has a share of competition, both new and established players coming in, but that is something we remain conscious of and determined to continue to maintain our leadership in that. We've been doing that. Last year was no different. This year will be no different.
Sure, sir. That's it from mine. Thank you very much. All the best.
Thank you. The next question is from the line of Amit Mahawar from Edelweiss. Please go ahead.
Yeah, thank you. Anuj, I just have one question. So if you see the category that we have, in terms of appliance, we still have a good headroom to cover in terms of total market size. If you see, which is more than maybe $2 billion alone in kitchen. So in terms of capital allocation, how should we think about it in the next 2-3 years? Will we focus more on the current categories where we will have revenue market share, or we will focus on some new categories altogether? So if you can help around capital allocation, because balance sheet wise, it seems we are seemingly on track, well on track if you see last couple of quarters. But in terms of next 3 to 5 years, we will still generate a lot of cash. So I just wanted that color on capital allocation. Thank you.
Amit, I'll answer the product question separately from a capital allocation question. And I've said this in the past that we will not diversify into categories for the sake of diversifying in terms of what is traditional looking growth, because anything we diversify into, we have to believe that we will be leading player, by leading player in the top 3 players. We have a competitive USPs or backing to make sure we remain or become a top 3 player in that. Number 2, my criteria there is, we will not compromise on strong double-digit growth, and we've demonstrated without too many diversifications over the last 8 to 10 quarters, we continue to deliver strong double-digit growth in our consumer business. So that is something we're committed to. Now, where does that growth come from? Does it come from increasing market share in our existing categories? Does it come from adding certain white spaces in terms of segments within our categories? Does it come from, certain geographies which were traditionally weak that we can, focus on? Or does it come from adjacent categories? Or does it come from new categories? To me, these are all the 4 or 5 dimensions from which this double-digit growth comes from. Of all of these, I would actually focus on this in exactly this sequence that I mentioned. That, unless I think the first 2, 3, 4 dimensions of driving strong growth are not there, I would want to focus on that rather than be distracted by new categories for the sake of it, because I believe there's enough room to grow in this. That said, we are not, we don't have an aversion to new categories, but that has to cross our filter of making sure we are leader for the long run. Otherwise, after 2 or 3 years, we don't want to become or remain a laggard in any new category that we enter in. Linking this to a question on capital allocation, I think, like you said, our balance sheet, given the trajectory that we are on, we will, another year to 18 months from now, flip over to having surplus capital. And we do have a certain intent in directional time on how we'll continue to use that capital judiciously and, use that to our competitive advantage. Again, that will not be new categories. So there are many ways to use that capital to add value to us and drive stronger growth. And let me just leave it at that right now.
Sure. Thank you, Anuj, and good luck to the entire team.
Thank you, Amit.
Thank you. The next question is from the line of Nitin Gandoria from Alpha Accurate Advisors. Please go ahead.
Hello, Anuj. Thank you again for the opportunity. Firstly, wanted to understand within our consumer segment. In the key product markets like lighting, fans, within appliances, also key product categories, what would be our market standing or market positioning in terms of say if you have the market share numbers on hand or a market ranking, and how has it improved over last 1 year?
So, as market share, I can talk at rank. So appliances, we are number 1 if you take it across the board, and within that, many of the subcategories, we are number 1. Okay. Fans, as I said earlier, we are probably a number 5 player. Lighting is a very commoditized multiple player, but I think we're close to number 5 there. The way we are seeing lighting in what we're reporting is slightly different from others, because lighting that you see is the consumer lighting, many other combined lighting. So if you add our illumination segment, you see the B2B and B2C lighting. Cumulatively, our rank in lighting jumps. Just in the B2B, B2C by itself, we are a number 2 player. Collectively, lighting may be close to a number 3 or 4 player.
Okay. And within appliances, we would be a market
leader. To add to that, sorry, one point. I think what is becoming more and more commoditized or crowded or fragmented is the B2C or consumer lighting, but the B2B, B2G project-driven lighting is a far more specialist field yet, and that's where we have been growing share and expect to continue to focus. So we expect more and more margins also to come from that side of the business.
Okay. And within appliances, what are, if you can segment, what are the major categories, where we are leaders? Mixer, I know of. Any other category where we are positioned well?
So the 3 largest categories where we're number 1 is mixer grinders, followed by water heaters, followed by irons.
Okay. And has there been any impact from competitors entering into each other's category or adjacent categories over last 1 year? Heightened competition, has there been any impact for us, or do you see going ahead any of it?
Yes, so there has been impact, and clearly we've seen competition increase over the last 2 years in appliances, but we've been seeing that consistently over many years. So I don't think last 2 years are unique in terms of other players who have been coming in previous years, and last 2 years we had used there. So there's also a certain amount of churn in that. But that said, competitive intensity is very high. But the numbers that you're seeing, despite that, or factoring that in, and we remain confident of holding our leadership in appliances there.
Okay. And so we had a policy of outsourced manufacturing. Most of our manufacturing is outsourced. So given going ahead, we'll be having surplus capital in hand. So within for the categories that we are market leader, are we looking to add manufacturing capabilities to have more cost control or any of this thing?
So I don't think structurally will change. We will continue to have a mix of outsource, which will remain majority of our sourcing, and we will have in-house manufacturing. But if you look at our overall revenue growth over the last couple of years, including this quarter, it's in the back of further capacity increase that we've done in-house as well as further purchase from outside. So while I say we are not shifting from outsource to in-house, we are actually been consistently adding capacity in-house across fans and appliances lighting is the only area where we've not been adding capacity in-house. In terms of going forward also, our decision on adding manufacturing will not be driven by capital, but will be driven by what is the cost or quality or strategic advantage of doing that. Capital will be available. It is even today available for that, but it will be driven more by operational considerations.
Okay. So currently our in-house versus outsourced mix would be what? And versus last year or versus last 2 years?
Broadly about 18% is in-house and 80 plus is outside right now. And that range will quarter on quarter based on which product is seasonality. Yeah.
Okay. Okay. And just lastly, on the distribution part, so we have the largest distribution footprint in India amongst all consumer companies. So are we looking to increase our distribution footprint? What is it currently in terms of retail touch points or pin codes covered, and is there any scope to expand this further?
So it used to be 2.2 lakhs, the total number of retail counters. It's closer to about 2.3 lakhs right now. But our focus is not to expand that footprint as much as to increase our counter share. So a lot of our growth has been coming from increasing our counter share, because my belief has been that in terms of reach we are very good, but we are not monetizing that reach well enough. So that's what we've been doing. Number two, within that also, given our urban-rural mix, I think our marginal potential to grow urban was much greater than many of competition. So our focus on growing our urban share is higher than many other players. Number three, within this, we're looking at more from a geographical perspective. Where are we weaker? So we do have pockets in that we're trying to fix. In terms of your point on pin codes, etc., I'll just have to see. I think in terms of servicing pin codes, that's a service area. We service about 16,000 pin codes. I don't remember offhand how many pin codes we sell through, but I don't think that will be less. That will only be higher than this.
Okay. Thank you, brother, Anuj, and all the best for you.
Thank you.
Thank you. As there are no further questions, I now hand the conference over to the management for their closing comments. Over to you, sir.
Thank you. So, once again, I'll wrap up with saying similar to what I said opening remarks. It has been a tough environment, but we're happy to have delivered strong numbers despite the tough environment. This is again a function of the new Bajaj Electricals that we've been building out. It is a far more resilient, agile and dynamic organization and more competitive. And that said, even our financial metrics continue to improve like we've been saying. We've held on to margins despite pressures on costs by actually improving other productivity efficiency items. We will continue to do that. And on a balance sheet and other perspective, we remain on track to actually continue to enhance. Lastly, on EPC business, again, our trajectory there continues. I'm confident that beyond this year, we should not have losses in the EPC business. Thank you very much.
Thank you. Ladies and gentlemen, on behalf of Ambit Capital, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines.